I'm Grant Walker. Welcome to Last Call for Thursday, the 4th of June. I'll be back with Heads Up, Friday, 10 a.m. In technology news, Apple has issued a voluntary recall for its Beats by Dr. Dre Pill XL wireless speaker. The recall coincides with a warning notice posted by a US government agency, the Consumer Product Safety Commission. Apple and the CPSC say the speaker's battery can overheat, posing a fire hazard. There have been 8 reported incidents of speakers overheating, including one case in which a consumer's finger was burned, according to the CPSC. The company is offering New Zealand XL buyers a refund or Apple Store credit, put at $519 in an Apple statement and at $425 on an Apple website for arranging the return of your XL speaker and compensation. The Beats Pill XL can be identified by the Beats B logo on the speaker grille and the words Beats Pill XL on the handle. The product is sold in 5 colours: black, metallic, sky pink, titanium and white. Apple hasn't released any sales figures for the wireless speaker. The CPSC says 233,000 have been sold in the US and Canada, indicating the recall and refund program will cost Apple somewhere north of about $70 million US. The Beats Pill XL was introduced by Beats by Dr. Dre in November 2013. Apple acquired Beats in late 2014. The recall does not affect any other Apple or Beats product. To court news, a private developer facing bankruptcy has managed to stave off inland revenue just months after winning a case against Wilson Parking over a $15.5 million property. In March, Mohsin Hagi sought approval in the High Court at Auckland for a payment plan on debts owed to multiple unsecured creditors. Mr. Hagi has total assets of $2.1 million, but his liabilities total more than $5.7. His March hearing was adjourned for a month because of what Associate Judge Tony Christensen called an undertone which suggests issues of credibility are involved. The $600,000 debt, to be paid in 2 installments over as many years, represents 15% of the overall debt and was approved by the unsecured creditors following a meeting on January 31st. But Inland Revenue, which was not present at the meeting where the plan was approved, wanted Mr. Hagi, who has a tax debt of $325,000, bankrupted. A judgment released yesterday, however, shows Mr. Hagi's payment plan was approved by Judge Christensen, although the $600,000 needs to be paid within 6 months. IRD lawyer Miranda Law had argued unsecured creditors who agreed to Mr. Hagi's payment plan would receive less than they voted to accept. 4 of the creditors voted for the plan, while 2 voted against. Ms. Law says the IRD had concerns about the running of the second and third creditors' meetings, including the acceptance of a text message as one of the positive votes. She says the IRD did not receive any letter about the third meeting, but it doesn't seem inconceivable the creditors did not expect the IRD to be at that meeting. Judge Christensen says there was an undertone of suggestion to her comments. Mr. Hagi's lawyer, William McCartney, said Mr. Hagi's proposed payment is a fair amount of money, leaving unsecured creditors better off than if he went bankrupt. But despite the judgment saying Mr. Hagi and his business enterprises are something of a mess of trust and corporate entities littered with debt, Judge Christensen approved the payment plan.
NBR Radio, Thursday the 4th of June. I'm Andrew Patterson, and with me, Calida Smiley. Calida, some interesting developments involving the Martin jetpack announced in the last 24 hours. Just background the developments.
Okay, well, yesterday afternoon there was a brief notice to the stock exchange, the Australian Stock Exchange, saying that the inventor and director of the Martin jetpack had quit the board. There wasn't really any more information than that. So when I saw that this morning, this has happened, I went to the company and they weren't saying much either at that stage. So I managed to track down the founder, so that's Glenn Martin. He's been working on this invention, this jetpack invention, since 1981, so it's his baby. He formed the company in 1998 and it listed on the stock exchange last February. And he's pretty disillusioned with the way things have been going since the IPO. He thinks it's got too corporate and he thinks that the jetpack's no longer the priority of the company.
So this is a classic falling out between a founder and a board that have got 2 different directions for the company.
Yeah, well, I don't know if it's a falling out per se, but it certainly seems that they've had a difference of opinion.
And is this all over for him now? Because, I mean, the brand actually carries his name.
Yes, the brand will stay the same. They're still going. I did talk to the chairman, managed to get hold of him this afternoon, and he says that plans are still going ahead for commercialisation. Everything's going as they said at IPO. And Mr. Martin, the founder, he's going to take some time out. He's going to go travelling around New Zealand for 6 months with his wife. I think he told me he feels relief that he's handed in his resignation. And I think he hasn't spent much time with his kids growing up because he's always been tinkering in his garage on his inventions. So I think he's just looking forward to some family time. He said he might keep up some sort of speaking engagements overseas because obviously lots of people are really interested in hearing about this jetpack.
Did he say specifically about where the issue lies in terms of what has caused this? Because obviously, he was a very instrumental part of this company. The company must be very disappointed to lose him. But was he forthcoming about what actually has driven this wedge?
Yeah, well, he said to me that it's no longer top of the priority list. He said it's fallen to about 7 on the priority list from the company's perspective. And he just says that it's now being pushed forward as the board's and as a corporate sort of vision rather than his as a founder vision.
Did you get a sense this perhaps has been simmering for some time?
Yes, I did. Yep, he said since the IPO he's been feeling really unhappy with the way things are going.
Does he regret the decision to go public, do you think?
No, I don't think so. He's made a lot of money out of it. It raised $27 million at IPO, and he's got to hold on to his shares for another 24 months. He's going to reassess at that stage whether he'll sell down or not. But he still feels very confident that it will reach commercialisation, and he says that a lot of people will be really excited to have their own jetpack in future.
And the company itself is still confident of meeting its prospectus forecast?
Yes, yep. There's no doubt that they're not confident about that.
Thank you for joining us, Callida Smiley, with us on NBR Radio.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To Auckland house prices. Auckland house sales and prices continued to rise in May as the property market in the country's biggest city soaked up an increased number of new listings. Real estate agency Barfoot & Thompson says the number of house sales rose to 1,225 in May from 1,070 in April and were up 11% from the same month a year earlier. The average sale price rose 2.2% to a new record of $822,148 in the month and was up 17% from May 2014. The median sale price was more muted, falling 0.5% to $750,000 in May, though was still 16.3% higher than a year earlier. New listings climbed to 1,740 in May from 1,580 in April and were almost a third higher than the same month a year earlier, though the sales activity meant the company's available properties for sale at the end of month were down at 3,060 compared to 3,151 a month earlier and 3,498 in May last year. Managing Director Peter Thompson says buyers are mindful prices are at an all-time high, but the combination of a sound economy, low mortgage rates and a housing shortage gives them confidence prices are not on the verge of retreating. He says during the past decade there has only been 1 year, 2013, when the company offered such limited choice as it entered winter. Auckland's property market has been a bugbear for the Reserve Bank. It's been trying to contend with strong currency-sapping imported inflation and creating a case for lower interest rates by limiting the regulator's ability to loosen monetary policy for fear of further inflaming housing demand in the country's biggest city. To try and quell the market, Governor Graham Wheeler announced plans to impose restrictions from October on highly leveraged residential property investment borrowing in the Auckland Council's regional boundaries. The bank expects the new rules will cut Auckland house sales by 8% in the first year and reduce price growth by between 2 to 4% at the same time frame. The government also announced efforts to reduce some of the incentives for investment in residential property, imposing a 2-year bright line test for house buyers. The tax department will chase capital gains more ardently and require foreign buyers to hold a New Zealand bank account and Inland Revenue Department number. Barfoot & Thompson says the budget initiatives didn't affect activity in May, and if they are to have any effect, they would show up in the June figures. To the banking sector. ANZ Bank's New Zealand arm has reduced its exposure to the dairy industry in the past 5 years and is emphasising its balanced exposure to the Auckland housing market. In a presentation to investors on the New Zealand operations, ANZ says its lending to the dairy sector has fallen from $13.1 billion in 2010 to $11.3 billion by March this year, taking it down from 14% of the loan portfolio to 10%. Over the same period, ANZ's total net loan advances grew from $109.1 billion to $120.4 billion. Earlier this week, dairy consultant Alison Dews told NBR Fonterra's low payouts to farmers will lead to farm foreclosures. Ms. Dews estimates most dairy operations require a $6 a kg of milk solids payout to service debt, but Fonterra expects to pay only $4.40 for the season that ended last month and $5.25 for the next season. The ANZ presentation shows only 6%, or $1.5 billion, of its mortgage lending in Auckland is to people with less than a 20% deposit, and that 59% of the mortgage book has less than a 60% loan-to-value ratio. The Auckland market accounts for 41% of ANZ's $64 billion mortgage book, with 11% in Wellington and 7% in Christchurch. Of the remainder, 26% of the book is lent in other North Island areas. About 73% of ANZ's mortgage lending is now at fixed rates, up from about 30% in 2012. Let's talk startups. 7 repayable government grants have been awarded to startups through the New Technology Business Incubators 7 months on from the scheme's launch. The total allocated since October last year is $3.15 million from the $31.3 million in new funding over 4 years set aside in the 2013 budget for grants made through the 3 technology incubators funded by Callaghan Innovation. Modelled on an Israeli incubator system, the privately owned technology incubators commercialise complex intellectual property mainly sourced from publicly funded research organisations such as universities and Crown Research Institutes. The repayable grants allocated so far have all been through the Powerhouse Ventures incubator, which has been investing in startups since 2009. The other 2 technology incubators, Astrolab in Auckland and WNT Ventures in Tauranga, have applied for some of the 22 pre-incubation grants worth $35,000 each, but none of the repayable ones. Repayable grants help prove up technology typically before angel investors will risk their money and pre-sales. The pre-incubation grants are a step earlier and allow the incubators to explore whether a promising technology is worth investing in. WNT Ventures Chief Executive Carl Jones said it was late to the party, only setting up in December last year. It is close to signing deals with 3 companies that would all apply for the repayable grants, he said. Astrolab had also taken some time to get its infrastructure and should have 3 to 5 companies entering the repayable grant scheme by the end of this month, according to Chief Executive Brett Oliver. Callaghan Innovation Business Acceleration Manager Kath Hopkins said the incubators were meeting expectations. Most of the grants related to intellectual property from public research organisations, and 3 went to startups that were already in Powerhouse Ventures' existing portfolio. The government contributes up to $450,000 over 2 years to successful applicants, matched by $150,000 in private sector investment. The grants started being repaid when the company begins to make sales, limited to 3% of total revenue per year. International experience has shown the repayment rate averages about 60%, but the grant is seldom recovered when a startup fails. Recipients include early-stage medical diagnostic company Tiro Life Sciences, CropLogic, which is integrating aerial image analysis technology, Avalia Immunotherapies, which is commercializing technology aimed at improving the efficiency of immunotherapies and vaccines, and Coty Technologies, which is developing ceramic coatings for bacteria-killing products for high-touch surfaces. They also include Certusbio, which is developing a range of biosensor technologies for industrial and environmental monitoring, Fluent Scientific, which is combining facial and voice analysis to increase the accuracy of emotion detection, and Invert Robotics, a startup based on robotic ultrasonic technology for detecting surface cracks in stainless steel tanks and silos.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
To Europe, the Eurozone's consumer price index has revealed the economy is no longer gripped by deflation. The Eurozone CPI, the measure by which headline inflation is calculated, increased by 0.3% month-on-month in May and will come as promising news to policymakers in Europe. The CPI dipped into negative territory in December last year, and with it came a period of deflation which lasted 5 months. In April, inflation was a flat 0%. It's the first time this year the Eurozone CPI has been in the black, and is particularly important as it shows the €1 trillion quantitative easing stimulus program could be making some headway. But Harbour Asset Management Head of Fixed Income Christian Hawkesby says despite the positive numbers, it's premature to say it's a direct result of QE. It's too early for the ECB to take complete credit for the fact Europe has avoided deflation. He says this data is more of a wake-up call, with much of the inflation experienced at the end of last year and through this year largely related to petrol prices. Now that's moving out of the measurement window, it's becoming more apparent that those deflation fears are slightly overblown. Deflation helped spark Europe's mass stimulus program earlier this year. QE aimed to stimulate the Eurozone through the European Central Bank and Europe's national banks purchasing debt of up to 60 billion euros, totaling more than €1 trillion. In a speech last week, ECB Vice President Vitor Constancio said one of the first challenges to consolidate the recovery of Europe is to overcome low levels of inflation. He said evidence supported the idea QE contributed to increased inflation expectations in the US when it was undergoing the stimulus program, which ended late last year. Energy prices continued to be an anchor to Europe's inflation, although components such as food, alcohol, tobacco and services are all up on the CPI measurement. Energy is still way down at minus 5%. However, despite still being a long way off all the other components, the amount spent on energy has lifted since reaching as low as minus 9.3% in January this year. To market news, Australian financial institution Perpetual continues to trim its stake in the Fonterra Shareholders Fund as the units come under sustained selling pressure. Perpetual remains the largest unit holder in Fonterra, having bought into the fund at the issue price of $5.50 in December 2012 and then adding to its holding throughout 2013 as the unit price reached a high of $8.09 in May that year. After topping up in August 2013 when news of Fonterra's botulism scare first surfaced, Perpetual moved to hold 14.3% of the fund. However, over the past 12 months, Perpetual has been a net seller, while the unit price has fallen nearly 20% to trade at $4.81 Wednesday, New Zealand time. Substantial shareholder notices lodged with the NZX show Perpetual sold about 1.58 million units between May 27 and 29 at prices ranging between $4.51 and $4.62. That followed the sale of some 2.53 million units between December 17 and May 26 at prices ranging from $4.52 and $5.72. Perpetual now holds 9.58% of Fonterra's fund. Deputy Head of Equities Nathan Parkin was not immediately available for comment. Units in Fonterra's shareholders fund, which give holders access to the co-op's dividend stream, fell below their float price in March this year, following the release of Fonterra's half-year result, which showed a 16% decline in profit. The dairy giant has also reduced its forecast milk price payout to farmers and reduced its forecast dividend range by 5 cents to 20 to 30 cents a share.
NBR Radio, Thursday the 4th of June. I'm Andrew Patterson, and with me now, Jenny Ruth. Jenny, the story out on Xero, cracking the 500,000 customer mark. How significant is this milestone for the company?
Well, it is pretty significant. You've got to remember that 4 years ago they had 50,000, and now they're tenfold larger than that. They've got a target in mind of getting to 1 million customers, and from the looks of it, it'll take them a lot less than 4 years to reach that target from here.
Is this a target that Rod Drury will be comfortable with? I mean, obviously publicly he's expressing support, but that this hasn't been perhaps as quick as he might have thought perhaps a year or two ago.
Oh, I wouldn't agree with that at all. I mean, when your company's growing as fast as Xero is, no. I mean, I don't think he has any disappointment at the rate the company is growing.
What do you think is being some of the issues that they are facing, particularly in the US? I mean, they're up against a formidable competitor, and this need to, I guess, reach critical mass. Could it be done any faster?
Right. Well, they're laying a lot of the groundwork now. Last year, Rod Drury was talking about it taking 3 years before things really took off in the US. We'd hope it would be quicker than that. But Intuit in the US, that's the incumbent software provider, it's been far more proactive in the American market than MYOB has been in Australasia, but MYOB would dispute that. But Intuit's customer numbers are just, I think it's up near the 1 million customer mark in the US. And they've been growing very, very fast lately. and Xero, it's less than 100,000, way less than 100,000. It's forming all these partnerships. A partnership with Apple is definitely going to help. Other companies that they've named, like Avalara, which sells software that allows companies to deal with sales taxes in the US. Companies like MindBody, Bill.com, Vend, and Deputy, both of those are cloud operators. All these are very useful partners. However, we still need to wait to see how that pays off in terms of actual customers signing up to subscribe to Xero software.
Do you think this is going to be their strategy to try and seek more of these partnership deals, which obviously allows them to grow faster?
Roger said that was always the strategy, that they would never do it on their own, that they'd partner with other companies. They've had quite a lot of accolades in the last little while. They've had quite a lot of accolades recently. It's just topped Forbes' list of the world's most innovative growth companies for the second year in a row. One of the biggest ways that you can express support for a company is putting your money where their mouth is, and in February they raised nearly $150 million from Silicon Valley investors. So the smart money is definitely betting on Xero succeeding. However, we do still need to see some results. You can't just fly blind.
And from this point, is it really all about the US?
I think it is. They do already have a substantial business in Australia, New Zealand and Britain. They've got customers in a few other countries here and there. They say 180 altogether. But the key market is the US. They could operate as a substantial business without the US, but the US is really going to make this from a local company to a truly global enterprise.
And just finally, the company is, I understand, presenting in Denver, Colorado. What else has come out of the conference?
Well, they've basically been presenting new developments in their software, and they're saying they're getting a very good reception from the people at the conference. There's about 500 people attending it. It's a XeroCon conference, so it's their own conference. It's a one that they hold regularly.
Jenny Ruth, thanks for joining us on NBR Radio.
NBR Radio with the Property Press. It's out now to show you around.
In People News, the Financial Services Council of New Zealand, which represents the nation's investment and life insurance companies, has replaced chairwoman Dame Jenny Shipley, who's facing legal action from the liquidators of collapsed property group Mainzeal. Rob Flanagan, former managing director of Tower and Guardian Trust, has been appointed the new chairman, the Auckland-based council said in a statement. Mr Flanagan chairs Guardian Trust and is a director of Airwork Holdings, Global Film Solutions and the Ministry of Education Infrastructure Advisory Board. In a statement, Council Deputy Chairman John Body welcomed the appointment of Mr Flanagan, who said he had wide industry experience and reputation. The statement made no mention of Dame Jenny. Mr Body didn't immediately respond to messages left on his phone. The former Prime Minister has chaired the council since it replaced the Insurance Savings and Investment Association in March 2012. A former chairwoman of Mainzeal, she intends to defend legal action being taken against her by the liquidators of the company, which collapsed in 2013. The claim against Dame Jenny and other former directors alleges a breach of directors' duties and seeks damages. And now a Xero update. Xero has passed another key milestone in gaining 500,000 customers, having grown tenfold in the past 4 years. Speaking from a conference Xero is holding in Denver, Founder and Chief Executive Rod Drury says he expects Xero will reach the millionth customer mark in less than another 4 years, but he won't be drawn on when his company will become profitable. He said it's not all that relevant anyway, because our business has changed so much in the last 3 years. A key question continues to be how fast and to what extent Xero can build its customer base in the US. At the conference, Xero has announced it's working with Apple and other companies in the US, including Avalara, which sells software to deal with sales taxes, Bill.com and MindBody. Mr Drury says Apple will be using Xero as its platform for small businesses in a similar way to what it did with IBM in the enterprise space. MindBody will be using Xero software in 42,000 gyms in the US. Mr Drury says, I think that answers a big question around our US performance. He says, we've always said it wouldn't be us on our own, it will be working with partners. Forsyth Bar analyst Blair Galpin says Xero has announced such partnerships before. He said all of those things are positive, but we need to see them convert into actual sales. Let's talk construction. New Zealand construction activity expanded in the first 3 months of the year as the country's house building effort grew for a second quarter, making up for declining activity in the commercial space. According to Stats New Zealand, the volume of building work across all building rose a seasonally adjusted 1% in the 3 months ended March 31st, turning around a 1% contraction in the December quarter. Residential work expanded 2.6%, its second quarterly gain, and offsetting a 1.2% decline in non-residential work. The value of work increased 2.5% to a seasonally adjusted $3.99 billion across all buildings, with residential work values rising 2.5% to $2.51 billion and commercial values increasing 2.6% to $1.49 billion. Business Indicators manager Neil Kelly said in a statement, residential building work increased mainly in Auckland and Canterbury, but non-residential building work chiefly increased in the South Island. The ANZ Business Outlook showed a split between firms' investment intentions, with growing expectations for more investment in residential construction and a declining outlook for commercial construction intentions. The building industry is struggling to keep up with demand in Canterbury, where the city is recovering from a series of devastating earthquakes, and in Auckland, where a shortage of supply has pushed real estate to record levels and seen a resurgence in new home builds. Today's data showed the two cities accounted for 60% of all building work. Auckland building work across all buildings rose a seasonally adjusted 0.8% in the quarter, turning around a 5.8% decline in December, while Canterbury work expanded 3.2%, adding to 5.3% growth in the earlier quarter. On an annual basis, construction across all buildings climbed 19% to $15.66 billion, with commercial building work up 18% to $5.93 billion and residential construction up 20% to $9.74 billion. New residential building work rose an annual 23% to $7.88 billion.
NBR Radio. Free to air online with business news you can use.
NBR Radio on Thursday the 4th of June. I'm Andrew Patterson. Welcome to Market Talk. Joining me, NBR News Editor Duncan Bridgman and Shane Solly, Portfolio Manager and Research Analyst at Harbour Asset Management. First to you, Shane. We've seen a bit more corporate activity this week. Of course, Z Energy announcing that it intends buying Chevron. What did you make of the announcement?
Yeah, it's a big deal for Z. It's $860 million of investment all told. Certainly, it's on the face of it, quite an attractive investment. Certainly, Chevron was a willing seller, and there's some upside in terms of synergies, cost savings, supply chain benefits, and so forth for Z. But it's not without its risks. There's a few hurdles to get through in terms of the Commerce Commission, and some significant integration issues as well. So, if it all goes according to plan, it is a positive investment for Z to be making. Certainly the multiple, the implied multiple to earnings before interest, tax, depreciation, assets, EBITDA, amortization, I should say, rather than assets, about 6 times versus where Z was trading before the deal, just over 8 and a bit times, or on a price to earnings multiple. They're effectively paying 9.5 times versus where Z was trading, which is 16.5 times. So a good price for the assets. Definitely the fact that Z is increasing its gearing or borrowings to fund the acquisition also gives a bit of a boost. Z takes its gearing up from 38% to 48%, so that's debt to total assets. And there's at the moment, given what interest rates are, that does give a bit of a boost. And I think that's a really interesting point. If you look at capital markets in the last few years, they've been very strong, and currently we've got very low interest rates and very high stock prices, which means buying assets in some cases is actually quite gives a quick earnings boost to some companies.
Do you think the Commerce Commission, Duncan, is going to really take a hard look at this? The market's almost assuming it's a done deal.
Yeah, well, of course, it's got to go through that process, and obviously the company would have done a lot of research and looked into it closely, and it is a risk, as we touched on before. I think the key area could be in the small towns and also neighbourhoods where there's little competition, and that could shrink further. And so there may be some aspects that will have to be tweaked as part of this deal. So it's going to be interesting how it's approached.
Let's talk about capital management, which has also been a feature of the last month. A number of companies announcing they're looking at capital returns to shareholders. Others are raising more capital. Shane, are you seeing a trend emerging here?
Yeah, I think it's interesting that you raise both sides of the coin. If I go back to, we've got a pretty hot capital market at the moment, and borrowing is relatively easy. So Spark talking about returning $100 million by way of a buyback, and Contact Energy returning $367 million by way of a 50-cent special dividend. That's about reflecting the fact they've got excess capital on their balance sheets, and they can boost earnings by increasing borrowings to fund those buybacks and so forth. On the other side of the equation, we've had people like Q Income raise $152 million, Precincts do $174 million, and a number of the financial groups raising bond issues. So it's telling you we are certainly getting to a strong or a high point in the markets. Capital companies are reasonably savvy about these things, and they're looking to tap into investor enthusiasm for particularly yielding securities at the moment.
Duncan, were you surprised at Contact Energy's capital return?
Well, yeah, the company spent quite a few months deciding which path to go down, because they'd flagged the idea of spending up to $1 billion on geothermal generation and investment overseas, and that didn't go down too well with minority shareholders, and I think there was quite a bit of pressure from institutional investors in New Zealand against that, and I'm sure Shane would have an idea on that. But whether or not it was a back down by Contact or not is a little unclear, although there was certainly pressure there. It might just be a sort of natural progression that the Contact board considered and decided that this was the path to go down.
And Shane, do you think actually that it was minority shareholders that convinced the board to change its view?
I'd like to think so. There's a lot of considered effort by a number of people. We were very active in the process in highlighting the relative merits of various options that have been put forward, and certainly the options that were put forward were pretty uninspiring from our point of view. It didn't stack up, and the risks were certainly not being rewarded for us as investors. So, we'd like to think that New Zealand investors have had a small win out of this. And importantly, it sends a bit of a signal to other companies as well. We want companies to stay on track. We want them to focus on the things they're good at and use our capital carefully. We don't give it easily, and we want to make sure people are earning appropriate returns.
Well, let's talk about bond yields. They've been rising. What's going on, Shane?
Really significant spike up in bond yields of late. Certainly, even overnight, we've seen Mr. Draghi from the ECB come out and highlight a recovery in European activity and some signs of inflation. And with capital markets being concerned about deflation, inflation rates falling, and certainly some signs of at least stabilising there. Probably the bigger kicker of recent has been the US Federal Reserve highlighting that it's considering or it's appropriate to start increasing its official rates. Janet Yellen coming out recently and suggesting that the US economy is in a reasonably strong heart and can afford to start looking to reverse some of the abnormally low short-term borrowing rates. But it really has caught some investors by surprise, the rate of change that's occurred there. And it wasn't so long ago. A classic example is German bonds. The 10-year bonds were down at 0 or very low rates, and now they're back to 0.8%, 0.9%. And certainly when German bonds got down to those very low levels, it did see a flow of capital pretty much across the world, including into New Zealand and Australia, in search of high-yielding assets. So that reversal has been pretty sharp and pretty quick.
Do you see that continuing?
Oh, look, there's a little way to go to normalise rates, not new normal post GFC is a different question, but certainly rates are lower than where they probably should be if we get a little bit of a recovery in activity.
All right, let's finally wrap up with the reporting season. What stood out for you?
Well, I think one of the most important things is it was a relatively positive reporting season. We did see more profit beats, beating expectations, and then misses. And subsequent to the reporting season, we've seen a net upgrade in earnings, pretty modest in the scheme of things. But then, New Zealand is modest, grinding higher is better than going the other way. Look, there's probably a couple of standouts, positives. Fish and Pike Healthcare, certainly strong growth with another 13% year-on-year growth in sales. A positive mix shift in terms of higher margin mask sales and respiratory acute care business sales, and some boost from falling production costs. So, healthcare continues on its long proven path of investment and growing carefully. Not necessarily on the other side of the coin, but possibly a little bit of a disappointment with Metro Glass, where it met its prospectus forecast at the earnings level, but slightly behind on revenue level. And that was very much about the sort of delays between the timing of building consents being issued and work being put in place, and a bit of a slowdown in retrofitting of some properties. So just weighing on the revenue side. But in total, it was a pretty solid reporting season. Most of the property trusts came out with slightly better numbers. So, quite a positive backdrop, really, for the New Zealand market.
Duncan, what about some of the more recent listings? How did they go?
Yeah, well, last year was the NZX biggest year for floats in quite some time, and there were 5 really that released their first result as a listed company, and by and large, most met their forecasts. I think it was Evolve Education sort of led the pack with a good result, and Arivita Group also did well. That's a retirement village provider. So, and then Metro Glass we mentioned before, which was slightly disappointing, and E-Road also that actually failed to meet its prospectus revenue forecast. So. That was due, the company said, to its revenue model changing, and so we'll be looking for some improvement there.
All right, and just briefly, what's on the agenda for next week, Shane?
Oh, yes, the biggie is the Reserve Bank of New Zealand's monetary policy statement. And there is a case building for an easing in official interest rates. Certainly that's what capital markets are factoring in. We're seeing export prices falling faster than expected. Certainly New Zealand's major trading partners' growth is slowing faster than expected. Unemployment coming in a bit higher than the Reserve Bank had expected at 5.8% versus the RBNZ's got a forecast of 5.5%. And inflation pressure remaining pretty modest. And obviously, since the last MPS monetary policy statement, the macro-prudential and tax policies have been put in place to control some house price inflation. So certainly there's a lot of components that are building to allow the Reserve Bank to ease. So that's probably the key one.
Thanks for joining us, Shane Solly, Portfolio Manager and Research Analyst at Harbour Asset Management, and Duncan Bridgman, NBR News Editor on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
I'm Grant Walker with The Last Call. Here's what's trending on NBR Online. Glenn Martin tells us why he's just quit the company he founded. Auckland house prices keep rising, as does building work, as does restaurant brand sales. Plus, something that doesn't go up, European rates. They remain on the hold. To find out more about our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. Let's head to Europe. The European Central Bank has left its interest rates at record low levels. The benchmark rate remains unchanged at just 0.05%, with the deposit rate and marginal lending rates holding at minus 0.2% and minus 0.3% respectively. ECB President Mario Draghi says our monetary policy measures have contributed to a broad-based easing in financial conditions, a recovery in inflation expectations, and more favourable borrowing conditions for firms and households. He adds that the quantitative easing stimulus program is proceeding well in lifting inflation. Yesterday, the Eurozone's consumer price index revealed the economy is no longer gripped by deflation. The CPI increased by 0.3% month-on-month in May, after being in negative territory for 5 months. In April, inflation was at zero. Mr. Draghi says he's optimistic about the inflation levels in the Eurozone, and he was not surprised to see the positive CPI numbers. He said the full implementation of all our monetary policy measures will provide the necessary support to the Eurozone economy, will lead to a sustained return of inflation rates towards levels below 2% in the medium term, and underpin the firm anchoring of medium to long-term inflation expectations. He says the CPI numbers have strengthened the ECB's conviction that it has taken the right decision with quantitative easing. Although Mr. Draghi is optimistic that QE is helping to lift inflation in the Eurozone, Harbour Asset Management Head of Fixed Income Christian Hawkesby told NBR yesterday it's too early for the ECB to take complete credit for the fact Europe has avoided deflation. Back to Martin Aircraft. The disillusioned founder of Martin Aircraft says the company is not going in the direction he wants it to, despite having worked on his jetpack design for more than 3 decades. The departure of Glenn Martin from the company's board, effective immediately, was announced in a brief note to the ASX yesterday afternoon. Mr. Martin founded Martin Aircraft in 1998 to commercialise his namesake Martin Jetpack, which he'd worked on in his Dunedin garage since 1981. The founder and director, as of just 24 hours ago, spoke candidly to NBR Radio about why he decided to leave so suddenly. He said, quote, "When I make a decision, I make a decision. Why would I want it to be effective in 2.5 weeks? I know I wanted to leave. You have to move on, right? My lifelong dream has always been to create a personal jetpack, and I pursued that dream relentlessly for 34 years. The significant part of that was to create a company where everyone can invest in the technology and dream of a personal jetpack, and I'm proud we've made great strides in that direction. But since the IPO, it's become pretty clear to me the direction the company is travelling in is not my vision," unquote. The Martin Jetpack has been honed over the years to carry a 120 kg load for 30 minutes, reaching up to 3,000 feet at 74 kilometres per hour, powered by a 200 horsepower petrol engine. Martin Aircraft listed on the ASX on February 24 after an IPO that raised 27 million Australian to fund plans which the company says will make it the world's first commercial jetpack manufacturer by 2016. But Mr. Martin is concerned the jetpack has slipped down the company's priority list. He said, "I started all this to create a personal jetpack, so I decided, well, it doesn't excite me doing all this other stuff, so it's time to leave. I'm still a significant shareholder in the company, so obviously I hope it becomes very successful, because then my shares will be worth more. But it's not my vision, it's the vision of a corporate entity with a board of directors and senior management team. In many ways, I haven't left the company left me. It's going in another direction, it's not mine." For more on this, go to nbr.co.nz. In legal matters, Auckland law firm Jones Young is being targeted in litigation kicking off this morning at the High Court as receivers for defunct finance company North South seek compensation for investors. North South Finance, a subsidiary of Dominion Finance, defaulted on its debts in 2008 and receivers were appointed in 2010. After paying back 65 cents in the dollar during a moratorium, it currently owes $31 million to debenture investors and a further $15 million to banks plus interest. Receivers Grant Graham and Brendan Gibson of Cordamentha estimate those creditors may receive a further 1 or 2 cents in the dollar. In March this year, they reported they were pursuing a legal claim against 2 parties relating to advances made to Dominion. The case was initially due to be heard last October, but was delayed to this month. Dominion Finance was the subject of a serious fraud office investigation that led to the conviction of its chief executive, Paul Kropp, in 2013. Dominion and North-South Director Robert Barry Whale was convicted of Securities Act charges in June 2013 and sentenced to 12 months home detention, 250 hours of community service, and was ordered to pay $75,000 in reparations to the company's receivers. Mr. Whale was at the time a partner of law firm Jones Young, which carried out some legal work for Dominion and North-South. Jones Young partner Keith Young said the case was being handled by its insurers. The case, North-South Finance versus Jones Young and another, was due for a pre-trial telephone conference in Chambers this morning. Another Dominion and North-South director, Anne Butler, wife of the late managing director Terry Butler, was sentenced alongside Mr Whale to 9 months home detention on Securities Act charges, along with 80 hours community work and $300,000 in reparation.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In local body politics, the Prime Minister John Key is hinting that the country's council should put some importance on the economics of property development and growth when considering applications under the RMA legislation. The government has ditched plans to reform Sections 6 and 7 of the RMA, which would have put economic growth on a level footing with environmental protection. Mr Key says the government can write RMA laws, but it takes the legislation only part of the way. He says we still have to rely on councils to interpret the RMA and planners to use it. He says the government wanted to merge Sections 6 and 7 as they are at the heart of the RMA's planning. The sections don't put any weight on the economic factors for development and growth, and Mr Key says councils need to start taking this into account. He said it's why we had to go outside the RMA and introduce special housing areas. Mr Key says Auckland's housing supply issues are not going to be easily solved and demand will not be choked off anytime soon. He says immigration, a growing economy and a backlog of housing supply will keep the city's housing crisis on the front page for a while yet. He says it will take a lot of interest rate increases to choke demand. People can withstand them for a long time because it's a slow lead-in time. He says the supply of housing has to be sped up and the government is joined at the hip with Auckland Council on this. To Christchurch, the government's belated announcement of further delays in consultation over the position of Quake outcasts has prompted condemnation from the group. The group says the Supreme Court clearly says the red zoning process was completely unlawful. The government should have consulted with affected residents. And now the consultation process initiated is completely wrong and is in conflict with the Supreme Court ruling. The consultation process is a public relations exercise in an attempt to legitimise unlawful policies. Quake Outcast was responding to an announcement from the Canterbury Earthquake Recovery Authority that public consultation on any compensation will be extended after more than 800 submissions were received. Acting Chief Executive John Ombler says he needs more time to consider them due to their complexity and number. He says Canterbury Earthquake Recovery Authority Minister Jerry Brownlee is expected to make his decision on the Chief Executive's draft recovery plan by July 31. After a recent Supreme Court ruling ordered Mr Brownlee and Sarah to reconsider compensation for the Quake outcasts, Mr Brownlee sidestepped it by throwing the question to the public via a submission process. The Quake outcasts comprises a group of property owners whose commercial, vacant and uninsured properties were red zoned by the government, which offered them half the value of their 2007 rating value. High Court, Appeal Court and Supreme Court hearings heard how in some cases the lack of insurance was because owners were preparing to develop their land and bare land cannot be insured. Some owners had acquired a section to build on and were awaiting designs and consents. Others advanced various reasons for failing to pay their insurance. Approximately 8,000 insured residents had their land red zoned and received government compensation at their 2007 rating value. An unresolved question is the extent to which the government's red zoning, rather than any actual land damage, caused loss to Quake outcasts regardless of insurance. Mr Brownlee's move attracted strong criticism. Sarah has yet to reveal the overall tone of the submissions. Many commentators have noted the complexity of the case and asked how equipped many members of the public would be to fully understand the issues. Seeking judicial review of Mr Brownlee's move remains a possibility. Let's go to the NZX. Trading activity on New Zealand's share market increased last month, driven by smaller value trades. The total number of trades rose 10% to 124,988 in May from the same month a year earlier, while the total value dropped 18% to $3 billion, according to Wellington-based NZX in its monthly shareholder metrics. The daily average number of trades advanced 16% to 5,952, while the daily average value slipped 14% to 141 million. The number of equity trades increased 11% to 122,341, while the value slipped 18% to 2.9 billion. In the debt market, total trades fell 6% to 2,647, while the value declined 0.9% to 94 million. The value of NZX's equity market climbed 15% to 102.8 billion, or 43.2% of GDP. The number of listed equity securities increased 1.8% to 171 from the year earlier. The value of NZX's debt market slipped 7.9% to 12.5 billion, or 5.3% of GDP. The number of listed debt securities fell 5.9% to 80 from the year earlier. Issuers raised 11 million of capital across 8 events in May, taking capital raised so far this year to 763 million. Shares of NZX last traded at $1.13 and have shed 3.4% so far this year.
NBR Radio with Bailey's, New Zealand's leading commercial real estate company.
NBR Radio, Thursday the 4th of June. I'm Andrew Patterson. Welcome to Ask Me Anything, and our guest today, NZIER Principal Economist Shamubeel Yaqub. Hi Shamubeel.
Hello.
Let's start off, firstly, questions from NBR reporter Chris Keel, who says, last week I was reading a Metro article on Auckland house prices, hoping for answers, only to find it quoted an exchange between the two of us, Chris and yourself, last year. You and Selena at the time were still in Wellington, and I asked if you would rent or buy when you moved to Auckland. You replied, we'll be renting. We've found a good range of houses to choose from, typically with a rent yield of 3%. We are saving and investing the rent. And you said that there was a shortage of houses for investment, but not to live in. How have you found the reality of moving from Wellington to Auckland, and was that situation what you expected to find?
Yeah, I think the move to Auckland was very much that housing is extraordinarily expensive to buy, but to rent it's relatively cheap. But at the same time, with our baby just coming last week, it's also this element of renting is such a poor substitute for owning in New Zealand that you really have some big issues in terms of stability and security. And so even though we are renting and we're relatively happy with that, we also understand that there are some big challenges for people who rent, particularly around the security of tenure.
Congratulations on the new arrival, and you have been quoted in recent months as saying that potentially you may consider buying. Is there a change of tune there?
Not really a change of tune. So for us, the decision to buy a house is not going to be one of investment, but one of comfort and of security. That's why we've been very deliberate and very careful in terms of saving while we've been renting. And we know that the risk for house prices in Auckland in particular is more to the downside than upside. With house prices over $800,000, with household incomes only around $80,000, Auckland is one of the most expensive markets in the world.
I mean, whether or not it's correct or not, in your case, it's definitely a fact that a lot of people buy a home for emotional security. How can the dismal science allow for the emotional and psychological factors that drive a lot of people's activity?
I think, the thing with home ownership is it's not all of it is emotional. There is a whole bunch of rules and regulations and institutional settings that force us or encourage us to buy a home. So our rental regulations, for example, are terrible compared to places like Germany or Switzerland. Our rules around banking and lending heavily encourage buying of properties. So there's a whole bunch of things that are geared up for that. But also there is a big emotional thing. That's not a bad thing at all. But what we find now is, we have this culture of homeownership, and homeownership is the dream and is part of that Kiwi dream. And that was exactly what was happening. So pretty much from the 1930s until 1991, the homeownership rate was rising. But since then, it's been falling. So the reality is that more people are living in rented homes. And regardless of what the emotion is, regardless of what the cultural expectation is, people feel like they're failing because they simply cannot get in to a very expensive, unaffordable, broken housing market.
So a question from the Watcher who says, is it frightening to you that Auckland house prices have risen more from their GFC peak than any other large OECD city? Should we be afraid of that?
It frightens me witless. I think Auckland is in a massive bubble, and the more this bubble inflates, the bigger the risk for the economy and for people when it bursts. We don't know when that will happen, but regardless of that, the big challenge is not only are we facing these economic and financial consequences of a housing bubble, it's also the social consequences, the people who are being pressured into renting, people who are being left out, people who are being priced out, people who are being marginalized in society. And it's becoming more and more of these people. So in Auckland, it's nearly 60% of 60% of people that are in rented dwellings. So it's not like it's an issue of the minority, it's the issue of the majority. And yet it's kind of in the shadows and it's kind of on the edges. And when you package together the risks to the economy, risk to the financial system, and this insidious risk to social structure, I really worry about what's happening in the Auckland housing market.
One reader asks about our reluctance to use the term bubble. It seems to be freely used. I mean, Treasury used it in Australia to describe the Sydney market just this week, but we seem to be reluctant users of the term. Has that surprised you?
No, it hasn't surprised me, and I think it's entirely rational. If you look at the people who tell the stories, they are generally homeowners and property investors. You know, you look at the politicians, for example, and how many properties they own, I think on average too. So we're in this impossible situation where policymakers, politicians, public figures want house prices to go up for people who own them, but house prices to go down for people who don't. And we can't have both. But the reality is it's too scary. It's too scary to say that there is a bubble because so much of our assets are in this one asset class. So much of our savings, so much of our economic security is tied up in this one asset. It is a frightening concept that it may not be there tomorrow.
You've written a new book, Generation Rent, Rethinking New Zealand's Priorities. What motivated you to write the book and what's been the reaction to it?
Well, the book is coming out this weekend. And the reason why we called it Generation Rent is because half of New Zealanders are now renting. And there seem to be the silent minority who are voiceless, who are without representation. And the idea of this book was to bring together our experiences, me and Selena's experience, because we've written it together, to give an economic perspective of what the situation is, how we have gotten here, but also what are the possible solutions to get us out of this mess. Now, one of the things that we stress is that we've gotten to this mess over many, many years. You know, the home ownership rate has been falling since the early 1990s. So these failures, these broken bits of the housing market have been in play for decades. And to expect a quick and easy fix is delusional, where there is a whole bunch of small, intricate things that we have to do together. And it's about fixing the rental market, it's about fixing the banking sector, it's about fixing taxes, and importantly, it's about fixing the responsiveness of housing supply.
So you mentioned before about a difference in Germany around renting. What specifically are the differences you see between Germany and New Zealand?
Yeah, so in Germany, it's pretty much the flip side. About 2/3 of households are in rented dwellings, whereas in New Zealand, it's 2/3 who live in their own homes. And in Germany, the rental conditions are very, very good. So in terms of security, in terms of how long you can stay in a place, what reasons you can be kicked out, whether you can make small alterations, all of these things mean that renting is actually very comparable as an experience to owning. And it's that ability to make a home of that shelter that's a big thing. In New Zealand, it's simply not possible. We're still stuck in this flatting situation in renting. Even though we know that the incidence of renting is rising across all age groups, it's still only geared up for young people who are very transitional, who are moving very frequently.
So do you think we just have to change our whole attitude towards renters and renting?
I think the reality is renting is going to be the way that majority of New Zealanders are living for some time to come until we fix the issues around affordability. In the meantime, we have to fix attitudes, but also we have to fix the rules around renting, which do not encourage and which do not really allow those long-term security, that ability to make a home of a rental property.
Another reader asks about the way that rental prices get struck, that ultimately they are tied to incomes. So is it going to be easier to control the pricing of the rental market, perhaps, that it is those who are seeking to buy a house for obviously long-term capital investment?
Yeah, so rents have been very stable relative to incomes over a very long period of time. And the reader is absolutely correct in that, generally speaking, your ability to pay is what dictates how much rents you charge. So as a result of that, what we have seen is house prices have risen a lot, but rents haven't. And so for us, the situation is that the rental market is not so broken that we don't have sufficient supply of rental properties, as it is in, for example, in Sydney, where the market is so tight that people are bunking up. There are people who share rooms because it's simply not the rents are so expensive. So New Zealand, in relative terms, is in a better position. I think there are enough positives in terms of the rental market, but at the same time, because the landlords quite often are accidental, they're in it for the capital gains rather than the rental income. The service that you get as a tenant is not very good. And it's about trying to find that right balance.
So Confused writes, I live in Wellington and have noticed that most of the good properties that are being sold are always being purchased by investors, which sometimes are a good 10 to 20% above their rateable value, which makes it almost a financial crisis for first-home buyers to afford, considered the banks will only fund up to 80% of the value. What will the future of New Zealand be like if this situation continues for the next 10 or 20 years? I mean, do you expect it won't continue for that long, will it?
I hope not. I think we have to fix this because the risk to New Zealand's social fabric is intense. If nothing changes, we're going to end up with essentially two classes of New Zealanders, the landed gentry and the rest. And to say that somehow New Zealand is going to go back to that kind of feudal, that land-based, wealth-based society rather than an egalitarian, equal opportunity society, that would be a terrible thing. But we know that right now it's only possible for people with existing stake in the housing market can get into the housing market. And as more and more young people are priced out, the separation, the inequality, the wedge that we create is going to create two New Zealands. And it's already happening, and it's been happening for over 2 decades. The time is now to try and fix this.
So Amanda writes, if Auckland Council and the government bumble along pretty much as they are now, only making a minor change to policy and regulation as they go, what are we in for, a hard or a soft landing?
Well, the way that we're going now is very slow, and that means that we are more likely to have house prices inflating for longer, followed by an eventual crash that's more painful. Now, we don't know how long that will take, but we know that there is a significant amount of urgency to try and fix this. What we have seen so far hasn't been fast enough, hasn't been big enough, hasn't been fundamental enough.
Matt asks, would a tax on foreign buyers and or requiring them to build new homes rather than buy existing homes help to cool the market?
It would help at the margin, but we don't know exactly how much because we have no records on how many foreigners actually buy houses here.
And that's fundamentally a problem at the moment, isn't it?
It is. So one of the things that we suggest in the book is collect really good quality data so then we can do this in the full glare of transparency rather than in the shadows and in this kind of this mudslinging against foreigners that takes place right now. So in Australia, they have rules like that, but they haven't been particularly effective. Their housing markets are just as rampant. So I think we just have to be a little bit careful about the magnitude of the issues and which are the main things that are driving it. For us, the main things are that we have rules that encourage investment, we have rules that supply huge amounts of credit into housing, and we have essentially rules around local government and housing supply that are too slow.
Liz asks, do you anticipate a surge in demand before the government's revised LVR restrictions and IRD registration requirements kick in October?
Absolutely. So whenever there is a new policy that comes in, there is a boundary effect, and you tend to get a surge in activity by those people who are going to be locked out or priced out, and followed by a dip afterwards. We saw this with the initial LVR restrictions that the Reserve Bank announced last year, and we're expecting to see exactly the same thing happen this year.
John says the Herald had a report about the purchase of an expensive Auckland house, putting it for sale, back up for sale within days of buying it, as the person said that their personal circumstances had changed. As it was not brought to sell at a profit but to live in at the time of the purchase, are they going to be exempt from the 33% tax on profit if sold before October?
Yeah, I don't know the details of that because we haven't seen all of that. It's under consultation at the moment. So, wait and see.
Alistair, welcome to Auckland, great city. I live on a postage-sized stamp section in Meadowbank, fairly central, house price soaring. Isn't it time that we cut some muscle and built some nice houses on the large pony club and golf courses there are? Thousands could be housed against the few people in central Auckland who own horses or play golf. I mean, are we going to have to be more realistic about the land that we do have available?
Absolutely. So the shortage of land in Auckland is entirely man-made. And the Auckland Council and government both have significant tracts of land which are probably not being put to the best use right now. And we have to have a very careful conversation about how we use these things. But the vested interests are so powerful. Try and move Remuera Golf Club and build houses on that, and you will see QCs lining up to stop that from happening. And that's exactly the problem.
So the power is lined up behind the property owners.
Absolutely. The vested interests are very, very powerful, and the vested interests are very much the property owners. And there is this weird thing where, even though we know there are solutions, they're not being implemented because it's not in the property owner's interest to let that happen.
We also know that younger voters don't tend to be actively engaged as voters. Is that part of the problem here, that this is a segment of the market that doesn't really get too vocal about these sorts of things?
Well, increasingly we're seeing some of these groups are becoming more vocal. So Generation Zero, for example, is a really good example of young people getting together behind issues that really matter. But at the same time, I think it's not just that they're, disconnected. They're resigned. They look at what's happening around them and what's available to them, and they feel like they can't access what their parents had. They cannot live the way that we have created the expectations for. And Andrew Dean wrote a book recently, Ruth, Roger and Me, and that's really about that angst that the younger generation feel, and they feel so disconnected and resigned. And in part, the motivation for writing Generation Rent was to give voice to that generation, to say that, look, we understand that these issues are happening, and it's sowing the seeds of massive inequality, which is going to be terrible for the society of New Zealand. But we know what the fixes are. What we need is courage and conviction to carry them out.
Has there been research undertaken amongst Generation Y about their realistic expectations of owning a house, or have they capitulated and basically accept that they are going to be renters now?
What we've seen around the world, and this is a global phenomenon, especially in the Anglo-Saxon countries where house prices are extraordinarily expensive, there is a sense of resignation. They don't expect to own. There's a great quote in Sydney recently, and the guy said he just graduated from university, and his ambition is to rent a better place, not to buy, because he just cannot see how, in his income and in his lifetime of work, he's going to be able to afford a house in Sydney.
Is that a good thing or a bad thing, do you think?
Well, I think it's a travesty. It cannot be that we say that that option is not available to you. Regardless of what happens, the choice to rent or own should be yours to make. And it shouldn't be because the market is so fundamentally stacked against one group against another. And that's exactly what it is now. Essentially, as long as you're a property owner, you're fine and you're protected, and all the rules in terms of banking, lending, taxes, all of these things are in your favor. But if you're a first home buyer or somebody who's coming into the market, it's not.
Do you agree with Bill English a couple of months ago, who said Auckland needs to accept it needs to get a bit more ugly?
Well, it does. And I think it doesn't have to be particularly ugly. And, you look at cities like New York, and, there are parts of New York you wouldn't like, but as a city, it's phenomenal. And, it's possible. It's possible to have good design as well as density.
But what you're saying is fundamentally the interest groups don't want to make that shift.
Well, nobody does, right? Once you own your lovely villa in Grey Lane, you don't really want to have a medium-rise building next to you. And I think that's the challenge, is we have created these rules where right next to the CBD we have suburbs that are low-rise. And, they're extraordinarily valuable pieces of land with fantastic access to work and play that lots of people want. And that's why the land is so valuable. But we're not making the most use out of it. And right now we have the wrong kind of rules around height, density, and parking restrictions and all those other bits and pieces, which means that it's not working.
So does Gen Y need to get more vocal?
Absolutely. Absolutely. Our plea to Gen Y, to Generation Rent, is unite, find your voice. Because if we don't complain, if we don't ask for it, there is no call to be answered.
Liz Bell writes, clearly the lack of infrastructure greatly impedes Auckland's ability to accommodate significant population growth. Do you think inbound migrants should be required to lodge capital solely into government infrastructure bond products?
Yeah, I mean, that's a conversation that people have had, and I'm not so sure about it. And it's because I'm not quite sure if it's the lack of infrastructure that's the problem. There is actually enough infrastructure within inner city Auckland to be able to, or within the central parts of Auckland, to be able to house many more people. And in fact, public transport networks would be far more efficient and far more user-friendly if we had enough density of concentration of people. So we could make much better use of existing infrastructure, but we're not. And what we're doing is we're building very expensive new stuff in greenfields and all of that kind of stuff. Not that I'm against greenfields, because you've got to have a bit of both to give choice to lots of people. The situation with immigration is that you can't look at it just within the context of housing. You also have to look in the context of why do we have immigration generally. And quite often is to fill quite a lot of skills deficits that we have in New Zealand. And we import a lot of the talent that we need for Auckland to be successful. So we've got to be really careful that we don't shoot ourselves in the foot. By trying to fix the housing market, we break what makes Auckland a great city.
So is that the same for the tax debate? Would a tax on foreign buyers or a much more full-blooded capital gains tax, again, make any difference? Because we haven't seen that having a lot of impact on other markets.
They're very much at the margin. And on the foreign buyers, I would rather know how much the impact was before we implemented a tax. And right now, because we don't even know how many foreigners are buying houses, it just feels like we're having this conversation on the basis of nothing. And I'd rather we had the facts and the evidence to be able to do that well. On the capital gains tax, I'd rather have it from a very purist economist perspective, because taxing capital gains means that it's even across all the sources of income. But we would like to see a capital gains tax being implemented in a broad basis, a comprehensive basis, and with other taxes being reduced to take away that bias of making incomes from capital gains in housing, for example, versus work.
Zahid writes, instead of focusing on capping property prices, if we could increase supply of housing and assist with personal saving with increased pay rates, wouldn't that be a better way of achieving more home ownership? I mean, that's probably ideal, but is it going to happen?
It isn't ideal, and the issue is we're not actually trying to cap house prices. And as we have seen over the last few years, our ability to cap house prices is zero. And our ability to raise incomes is also limited. If you look at the conversations we've had around productivity of New Zealand, pretty much since the early 1990s, it hasn't changed. So it seems to me like it's really important that we fix the issues that are slowing housing supply. And the reader is absolutely correct. That fundamental issue about housing supply is incredibly important.
Okay, Sasha, what changes in tenancy regulations would make the most immediate impact for renters, do you believe?
I think reforming the tenancy agreement would really help a great deal. So right now our standard agreement is 12 months. We would like to see that being increased to 3 years, for example.
So almost like more of a leasing operation.
That's right. And still leaving the option for people to change if they want to. It's not about trying to force people to have just one way of renting and one type of contract, but it's to say that it's important to try and nudge the market into a more longer-term way of living in a rental property. And the thing is, all of these things have actually been tested, and we've got some very good models in places like Germany and Switzerland where it is working. And they do have much better quality of life. And what we find in New Zealand, for example, is that the satisfaction with housing for renters is much lower than it is for owners, whereas in places like Germany and Switzerland, that is not the case.
So on this debate about the housing prices being inflated by overseas investors, where do you stand on that fundamentally?
So from the data that we have looked at, we do not think that they are the major cause. The biggest margin
that's going to run counter to what people think, isn't it?
Well, I think there is an undercurrent of racism in that conversation. But if you look at the evidence, it is generally people with many properties who are buying many houses. And so, when we look at that, it's clear that it's people who've been in the market for a long time. It's people who already have many houses who are buying more houses. So it is investors, it is people who are betting on capital gains, and that is the big driver that's driving this very strong housing market in Auckland right now.
Because you've also compared that to a Ponzi scheme, that it's the same group of people selling the same properties on an ever-increasing basis to each other.
That's right. And because housing is becoming unaffordable, it means that fewer and fewer people are able to participate. And essentially what we're seeing now is fewer and fewer people swapping houses with each other at rising and rising prices. And it's the greater fool theory, and it's a Ponzi scheme, and it's a bubble, and it's all of those things. All the hallmarks are there, that the only way housing purchase right now makes sense is if capital gains are running at somewhere between 8 and 10% a year, every year, forever. And if that happens, then housing will be completely unaffordable within 10 years. Currently, a young couple would spend about half of their income on mortgage payments. If house prices rise at 8% a year, it'll be 100% of their income in 10 years' time.
Louise writes, National has mulled the idea of awarding more points for potential migrants who pledge to settle outside Auckland. Do you see that working?
Look, it's one of those conversations we had with my last book, which is called Growing Apart and was better known as Zombie Town. But essentially, it's hard to ask people to go to a place where there aren't job opportunities. And again, the question is it the inflow of migrants that's driving up house prices in Auckland? So if you look over a long period of time, net migration adds about 20% of housing demand. 80% comes from natural population growth and changing family circumstances. So it's very hard to argue that the bulk of the demand is coming from migration. But what migration does do is it creates the volatility in housing demand because it's very cyclical and very up and down. A couple of years ago, we were wringing our hands. Net migration is negative. Everybody's going to leave New Zealand. And now we're saying we have too many people coming to New Zealand.
And that's flipped in just a couple of years.
Exactly. And that volatility means that the housing market is facing these immense changes in demand and it can't respond fast enough. And so that tells me that the issue is not that the demand is there, which is cyclical, but the market, the supply of housing is not responsive. And it goes all the way from release of land, the infrastructure provision, the heightened density, the building firms, the capability and capacity within the sector to produce those houses. It's all of those things. But fundamentally, the big challenge with migration is that our housing market is not able to respond in a timely fashion.
Speaking about a zombie town, you attracted some flack for the use of that term. Colin writes, you're on record as saying that Northland is like East Timor. Have you actually been to East Timor?
No, I haven't been to East Timor. And, if you read the book, you'll see how I made the comparison. The Northland is really struggling. The concentration of deprivation and poverty is intense. And the reason for talking about zombie towns is to draw attention to what is clearly happening, to say that it is ridiculous that policy and politics is dominated by the average and the median, which is inevitably Auckland, with very little regard for what is happening in other parts of New Zealand. To say that we're going to make policy that has no regard for what's happening in places like Northland, which experiences none of the housing boom, none of the growth in jobs, and that it's going to be okay, is not realistic. So whether or not you take offense, I don't care. The reality is we're talking about something that's really important, and it's about shifting the policy conversation from the average and the total to the distribution and the inequalities that are clearly there across different parts of New Zealand.
Are these issues linked about the lack of regional economic strategy and booming Auckland house prices? Because clearly this is where things are happening.
Yeah, so with the housing situation, that housing crisis is very much an Auckland thing. And we have deliberately talked about this, in the Auckland market because this is where the pressures are, this is where the population growth is, this is where people want to come. Because in many ways, this is the future of New Zealand. To pretend that we're likely to go back to the glory days of provincial New Zealand is unrealistic. But it doesn't mean we should give up on them. It's about saying, how do we create opportunities? How do we still create enough of an economic base for people who choose to live there? And it's about the equality of access to opportunities. So, look, the regional story is a really tough one, and the divide that we see is very true, whether it's in jobs and economic performance or house prices. What's happening in Auckland is very different from the rest of New Zealand. And it is really important that we have the right policies that fix the right things, while still having that, delicacy for what's happening in the other parts of New Zealand, which will be collateral damage for any policies that are introduced to fix the housing market in Auckland.
I'm going to finish with a question from Amanda, who writes, after a freak electrical storm and it alters their brain activity, John Key and Len Brown appoint you Auckland Housing Czar with complete power to implement any legislative or regulatory measure you would like to address house pricing. What would you do as the Auckland House Czar?
I would do two things. The first thing, I would use council and government-owned land and rezone it all for medium-density housing. And the second thing I would do is change the height restrictions as they were proposed in the initial draft unitary plan, because I think there was enough supply, there was enough good design in that would give a significant amount of boost for where Auckland is heading.
But we know that's going to attract, as you alluded to before, this controversial response. So how do you deal with the opposition to that? Does the government just legislate that they can somehow push that through?
Well, actually they can if they want to. So if you look at the way that local government is set, it's a beast of legislation. The government wills it into being. And if the government really wants to, it could. But that's a massive attack on local democracy. The way to do that would be to balance the input from the vested interests against those who don't have a voice. And I mean not only the people who are living and who are renting, but also future generations who have no say in this. And I think they're the ones who are being missed out in this conversation, is the greed of the current generation who are doing very nicely, thank you, from the increases in capital gains of the last however many decades. They're essentially robbing the future of their children and their grandchildren.
Shamabil Yaqub, a principal economist at the New Zealand Institute of Economic Research and author of Generation Rent, Rethinking New Zealand's Priorities. Thanks for joining us on Ask Us Anything.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
And now a warning from the Reserve Bank. The Reserve Bank says surging Auckland house prices will put New Zealand's lenders at risk if there is a significant downturn. Happy with the lenders' ability to stay within regulatory requirements just 6 months ago, the central bank is seeking feedback on plans to impose new macroprudential restrictions on residential property investors' ability to buy high-leveraged housing, which the bank sees as the biggest risk to the country's financial stability. When the RBNZ ran stress tests on New Zealand's financial system last year, it found the country's lenders could withstand a significant housing market downturn concentrated in Auckland, with capital ratios falling to within 1% of the minimum requirements. Since the scenarios for the test were finalised early last year, Auckland house prices have climbed 18%, and the bulk of lending has gone to Auckland, with property investors' share of housing purchases increasing. The bank says our assessment is that stress test results will be worse if the exercise is repeated now. The bank says in a consultation paper issued yesterday on its proposals to impose higher loan-to-valuation ratios on houses bought in Auckland. RBNZ Governor Graham Wheeler last month announced the plans to introduce new restrictions, which will apply from October and require investors to have at least a 30% deposit. The bank says property investors, rather than home buyers, increased their share of borrowing to about 40% of the property market from 35% before the first set of loan-to-value ratio speed limits were imposed in October 2013. At the same time, it introduces the new Auckland investor rules. The RBNZ plans to ease LVR limits outside Auckland, where modest levels of house price inflation are not causing concern. The paper says while there is a risk there could be a re-emergence of house price pressures outside of Auckland, it would take a sustained period of strong growth before valuations became as stretched as in Auckland. The Reserve Bank says residential property investment loans have relatively low default rates during normal economic times, but a downturn would bring a rising rate of defaults. The new measures are expected to cut Auckland house sales by 8% in the first year and reduce price growth by between 2 and 4%, while increasing sales outside the nation's biggest city by 4% and lifting non-Auckland house prices by 1%. The Reserve Bank also confirmed it will press ahead with plans to introduce a new asset class, carving out residential property investors as a subset of bank loans and requiring banks to hold more capital against those loans. The microprudential initiative is needed to impose the broader restrictions on highly leveraged lending to property investors. While you were sleeping, Wall Street moved higher amid optimism Greece will reach a deal with international creditors soon. While the latest US economic data kept alive expectations, the Fed Reserve won't raise interest until at the earliest September. In late trading in New York, the Dow Jones Industrial Average rose 0.53%, the S&P 500 added 0.36%, and the Nasdaq climbed 0.54%. Marshall Gores, Chief Executive Officer of Geneva Fund Partners in Denver, Colorado, told Reuters, as the risk around Greece is starting to significantly reduce, investors are putting back money into US equities. To be sure, risk remains and investors are wary. Europe's Stoxx 600 index ended the session with a 0.1% decline. The UK's FTSE rose 0.3%, France's CAC 40 increased 0.6%, and Germany's DAX gained 0.8%. In contrast, Greece's ASE index jumped 4.1%. Meanwhile, President Mario Draghi reaffirmed plans for the European Central Bank's monthly €60 billion bond buying program to continue through September 2016. He noted, however, economic growth in the euro area is likely to continue to be dampened by the necessary balance sheet adjustments in a number of sectors and the sluggish pace of implementation of structural reforms. In the US, the latest economic reports offered cautious optimism about the pace of growth. According to the Fed's Beige Book, reports from the 12 Federal Reserve districts suggest overall economic activity expanded during the reporting period from early April to late May. Separately, ADP Research Institute said US companies added 201,000 jobs in May, after a revised 165,000 increase in April. And other reports showed the US trade deficit shrank to US $40.9 billion in April, after it ballooned to a revised $50.6 billion in March, while the Institute for Supply Management's non-manufacturing index slid more than expected to 55.7 in May from 57.8 in April. Business news, Xero has passed another key milestone in gaining 500,000 customers, having grown fourfold in the last 4 years. Forsyth Bar analyst Blair Galpin says it's a good result, but it was always on that trajectory. We knew it was fairly close. The accounting software company had 475,000 customers at the end of March. The company gave no breakdown of where the growth came from, but Mr. Galpin says most of it will have come from the strongly growing markets of Australia and the UK. A key question continues to be how fast Xero can build its customer base in the US. Xero's founder and managing director Rod Drury says the company now has its sights firmly set on getting to 1 million subscribers. Mr. Galpin says given the current run rate, it could be expected to take less than 4 years it took to grow from 50,000 customers. The run rate is ramping up every year, he says. Xero shares last traded at 20.40 and have gained 26% this year. The stock is rated an average sell based on 5 analyst recommendations compiled by Reuters with a medium price target of $20.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
NBR Radio, Thursday the 4th of June. I'm Andrew Patterson. Welcome to Media Watch, and joining me, Nick Grant and Campbell Gibson. Welcome to you both. Let's start off with MediaWorks. Big week for them. Nick, what did you make of the way those decisions were actually made, particularly regarding John Campbell?
I am a bit agog, actually, and so pretty much all the people within the TV sector that I have spoken to about it. I mean, clearly it wasn't MediaWorks' choice to conduct the review of Campbell Live in the full glare of publicity, though why they chose to do it the way they did, it's I really don't know. There might be a clue in the fact that reportedly the sponsorship for the show from Mazda was due to finish at the end of last month. Though, as we understand it, that MediaWorks had requested that sponsorship to wrap up when it did, rather than have it for the full year. So, but interestingly, the New Zealand Herald was leaked a copy of the review findings, which they posted on their site on Saturday. And goodness me, it makes the Labour Party review of their election disaster look detailed, rigorous, and eminently sensible. It's, there have been lots of accusations about the idea that there was a predetermined outcome for the review. MediaWorks have been very firm with the idea that it hasn't. Mark Jennings, head of news there, who's incredibly well respected throughout the industry and within MediaWorks, has been insistent that he was given a free hand in it. But it's a fairly, the review is a very thin 1, 2, 3, 4-page document. Much of it taken up with graphs that show that John Campbell was almost twice as popular as the next preferred current affairs presenter in the country. 29% think John Campbell is the best versus Mike Hosking at 15. So Paul Henry at 14 and so on. In some respects, it makes the decision seem even less comprehensible than before.
Declaration of interest. Of course, I am a contractor to MediaWorks, but Campbell, you've followed the situation fairly closely too. What do you think in the end was the driving factor for MediaWorks as to why it felt it needed? Was it out of line with the overall strategy for the company? Do you think?
Yeah, there's been so much discussion on this. It's almost hard to know what to believe unless you're on the inside in that company. But I guess the thing that they and you can actually bring in Nielsen to this discussion, because Nielsen said that its ratings should be used on a long-term basis. They should not be used on a short-term basis. So when MediaWorks would have seen John Campbell's ratings declining, they would have probably said, okay, it's declining, let's just see how it goes in the long run though. And as soon as it just didn't show any signs of recovering, they decided, let's announce a review. And then obviously ratings spiked. But as many observers have said, that's a short-term sort of solution or short-term boost, really. So there was I just don't think for a commercial broadcaster there was any reality in continuing to show John Campbell. Obviously he's a great presenter and a great journalist, but for them, obviously, they just weren't getting the commercial return. I've seen the rate cards for their advertising, and it was half the price of some of their other shows around the same time slot.
And what about when you build the cost element? 24 journalists employed. This is an expensive business, right? How much do you believe cost actually might have come into that decision? Yeah,
it's interesting because on their Facebook page, the John Campbell page actually said, we run at a profit. It's always run at a profit. So I guess the question of that is how much of a profit they were running at. Obviously, they just didn't see that they were getting the return they needed.
It was interesting, though. I was talking to a couple of well-placed sources about that very thing yesterday, and they were quite insistent that that not only was Campbell Live profitable, but it was comfortably so. It wasn't just scraping by on the skin of its teeth. The review does talk about declining sponsors contracting shorter periods and reducing the amount willing to pay, but certainly these sources were suggesting that the program wasn't in a parlous financial situation, and it was actually delivering good financial results. But I think there seemed to be a grass is greener attitude at MediaWorks, and that this is not doing as well as we'd like. So it needs to change in some way.
Of course, it's not only MediaWorks facing the cuts. Fairfax, of course, announcing that it was reducing its staff size as well. Is this just a continuation of a theme with media, having to do with less?
Yeah, I think so. It's those companies that depend on that have free content. They're struggling with the new model that they're trying to implement. Advertising is just not delivering as much of a return online as it is for their other mediums such as TV and print. So Fairfax obviously is just it's been through many restructures in the past year. I think there were a few jokes over how many names they've gone through for these restructures, but it is just a tragic situation that doesn't seem like they're Well, actually, they're actually making a profit in this country, but obviously, the same as MediaWorks, there's an attitude that the grass is greener, so it could be better.
What interests me is that none of the mainstream organisations are growing. I mean, they're all shrinking.
Yeah, well, it's just when the internet started, no one thought that they would charge for it, and now mainstream media is still feeling that pinch.
Nick, do you see this just as a continuation that this is unlikely to change? This is one of those sort of drip, drip, drip situations?
Yes and no. Obviously these companies, particularly Fairfax, made a great song and dance about the fact that they were the restructure as part of being much more digitally focused. And MediaWorks has also talked about the fact that it's a multi-platform company, digital, radio, TV, and the lean is increasingly towards digital. And that is the right thing for all media companies to be looking at. Similar here at NBR with the growth in terms of nbr.co.nz. Because in a PwC survey that just came out, a report that just came out today, talks about the fact that digital advertising is going to continue to grow and grow and grow and grow until it replaces pretty much all other traditional forms of advertising. So, I guess the problem is when, as you say, these companies aren't growing, they're contracting. Fairfax has talked about the fact that they're going to have more reporter roles as a result of the restructure, less middle management, which is a good thing, I think, because I do see an unfortunate trend where a lot of media companies, which are increasingly owned by corporations, run by people with no media experience, just see content as a cost item as opposed to the very heart of their business and what actually brings the revenue that they make. So I think that Fairfax focus on more reporter roles, although they're obviously going to lose a lot of experienced people and some institutional memory. But I think that is positive. Obviously, a negative for those experienced people who will probably find themselves without work.
Let's finish with the other big media story of the week, the issues associated with sponsorship and reputational risk, particularly if you happen to be associated with FIFA, Campbell.
Yeah, so that situation has been very interesting to watch it unfold, and there's been a few questions about what sort of involvement the sponsors had in sort of pressuring FIFA to make some changes, but it seems like the investigations were the things that finally tipped them over the edge and caused Blatter to resign. So I've had a few discussions with some sponsorship experts on the subject, and they say that the sponsors will make a lot of noise and they'll say changes need to happen, but at the end of the day, they're one, not going to abandon them, and two, it's not going to badly reflect on their brand because they've enjoyed being associated with this huge sport and this huge organisation for such a long time that they would never even consider stepping down and ending their partnership. It's just something they'll weather the storm, and they'll come out hopefully once this gets solved. They'll continue to enjoy that partnership.
And seeing one of the biggest sporting brands in the world, it's almost a brand that you cannot afford to not be associated with.
Why would you give that up?
Absolutely. Yeah. Thank you for joining us, Nick Grant and Campbell Gibson, on Media Watch here on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Two market results. Restaurant Brands, New Zealand's largest fast food store operator, increased first quarter sales 15%. Revenue jumped at fried chicken outlet KFC, its largest unit, and the company added more stores to burger chain Carl's Jr. Sales rose to $89.1 million in the 12 weeks ended May 25 from $77.7 million a year earlier, the Auckland-based company said. Same-store sales, which excludes changes in store numbers, increased 7.6%. The company's KFC unit, which accounts for almost three-quarters of sales, boosted revenue 13% to $64.4 million in the quarter, ahead of the 5.2% pace a year earlier. The chain has refurbished stores, stepped up marketing and extended opening hours. Same-store sales rose 9.8%, excluding the addition of a new store at Albany, taking the chain's total to 92. The company says successful promotions in the quarter were the Super Zinger Burger, Zinger Stacker Burger, Crispy Burrito, as well as a highly successful Super Bucket with a free rugby ball as part of the KFC New Zealand Super Rugby team sponsorship. Shares in restaurant brands rose 1.4% to a two-week high of 444 and have gained 19% so far this year. Carl's Jr., the company's newest brand, more than doubled sales to $8 million from $3.7 million after it added 10 stores to the chain, taking the total to 18. Same-store sales slipped 5.2% compared with a 36% drop the year earlier. Some stores showed positive growth while others rolled over high opening period sales. Pizza Hut sales fell 7.6% to $10.5 million as the company exited 4 stores in line with its plan to sell underperforming outlets to franchisees. It now has 46 stores. Same-store sales slipped 0.5% as the year earlier period was boosted by a hot dog stuffed crust promotion. Some 43 Pizza Hut stores are now operated by independent franchisees. The company's Starbucks coffee chain increased sales 6.6% to $6.1 million, even as it had one fewer store than the year earlier, taking its total to 26. Same-store sales jumped 8.9% ahead of the 5.5% increase in the year earlier. It said the chain benefited from better value and improved customer experience initiatives implemented over the past 2 years. In business news, a program run by a financial services provider to boost women through its ranks has expanded to include women from other major organisations after it noticed there was no other such scheme running here. AMP started its Women in Leadership program in 2013 with attendees completing a one-year course that includes effective conflict management, executive presence and confidence training and individual career coaching. About 20 women have been chosen to do the course this year, bringing the total to 50 over the 3 years the course is run. Women make up more than 50% of graduates, but hold just 19% of the country's senior executive roles. There seems no easy fix to overcome barriers ranging from re-entering the workforce after maternity leave to breaking through old boy network glass ceilings. Measuring the success of coaching programs such as this one is tricky, admits AMP Human Resources General Manager Sean Philps. However, he says 60% of the women who've completed the course so far have moved into a new role at AMP. He says what that's saying is the program is giving them the skills to move outside their home domain. When you look at the engagement of the attendees, it's substantively higher than their co-workers. The gender split for AMP is 59% female, 41% male, and for managers and above it's 55% male, 45% female. The company's return to work rate after parental leave is an 80% rolling average, above the New Zealand average of 75%. Mr. Phillips says AMP is comfortable with how its gender diversity is tracking at the moment and does not have a specific target to increase women in management positions. This year, AMP decided that bringing on women from other organisations and paying for them to complete the course was its corporate duty, as it helps expand the national pool of women leaders. Mr. Phillips says the benefit for our organisation certainly outweighs the cost. He would not disclose how much the course costs to run, though. He said we have a responsibility to our shareholders, but it's also important we have a responsibility to the community that we're part of. This year's intake includes senior women from Air New Zealand, Coca-Cola, Amatil, Foodstuffs South Island, Greater Wellington Regional Council, Ravensdown and Roche. NZX's gender diversity statistics for 2014 recorded 14% women directors on listed companies' boards, 3% up on the previous year. The Institute of Directors Mentoring for Diversity program is another scheme pushing progress along. It's seen at least 75 women intern on boards to gain experience since it began 3 years ago. This year, the program has been expanded to promote wider board diversity, with the latest intake considering ethnicity, age, skill set and background as well as gender. To politics, Prime Minister John Key has produced his strongest condemnation yet of New Zealand First leader Winston Peters. Mr Key last year left the door open for National to work with New Zealand First if necessary, although in his previous 2 elections as leader he had ruled out any arrangement, stating he would waste too much time dealing with Mr Peters. Last night, speaking to a KPMG business briefing in Wellington, Mr Key was vocal in his opposition to New Zealand First's whole outlook. He told the meeting, in all my time here, I've been pro-immigration. If you really look at my speeches and Winston Peters' speeches, we're on different planets. That's just the reality, he says. Most of the stuff he says, I just violently disagree with. He says at present New Zealand cannot afford to say to firms such as Xero or Trade Me they cannot import a skilled worker whose presence would probably lead to the employment of 3 or 4 other New Zealand workers. He said, we've been strong beneficiaries of migration. They brought capital to New Zealand, they brought skills to New Zealand, and they brought hard work to New Zealand. He cited the Croatian winemakers in his own Helensville electorate and the recent wave of South African migrants as bringing a strong ethic of hard work to New Zealand. He said, we would be a poorer country without it. The nature of the New Zealand economy is those skills are needed in Auckland because most of the work is there, he says, although he concedes the government could probably do more to encourage migrants to places other than Auckland. The comments are significant because it's been expected National would try to reach out to New Zealand first, or at least repair some of the tensions between the parties over this parliamentary term. It's taken as almost a given in some political circles that National will not be able to get a 4th term in government without some sort of arrangement with New Zealand first.
NBR Radio with the Property Press. It's out now to show you around.